Hi, my name is Roy Rumbo. I'm an accounting professor at the University of North Texas, and I'm going to be sharing with you today I'm going to be working some problems on the time value of money from chapter 5 in McGraw-Hill's Spiceland, Nelson, and Thomas textbook. I'm recording this for my UNT class, University of North Texas class, intermediate accounting 2. This is actually the first very beginning lecture for intermediate 2, because there are so many concepts like bonds payable and lease accounting that use the time value of money. It's an integral part of the course. I would say time value of money is still valuable to know as individually, personally, for investing purposes or borrowing purposes. But it's, that's what companies do. They lend money and borrow money. So it's very important for them. So I'm going to share my screen and get started here. And I'm going to definitely, I'm going to work 5 problems. I already had the time value of money lecture. It's out there. I discussed time value of money. So this lecture is only about, working problems. And so let me get rid of this floating meeting controls. I just I know to move my face out of the way here for at least for me. You guys can't see any of this, but I can see it. So again, let's talk about time value of money. And so we're always talking about one of 2 things. Well, 2 things really: cash inflows and cash outflows. So if you are borrowing money, day 1, you have cash inflow of money. That's day 1. And then down the road, you're going to have a cash outflow. Now, there could be 2 types of cash outflows. There could be payments along the way, and then there could be a principal payment at the end. How much, the stated value of what you borrowed, you might have to pay that at the end, or maybe you only just pay payments. So there's one cash inflow, and there's a whole series of cash outflows. And we're trying to understand, what the present value of those are. That's the value today versus a future value. Now, the difference between the present value and the future value, that's interest. So interest is nothing more than the cost of using someone else's money, in this case. Or you could have the opposite: cash outflow up front, and then a whole series of cash inflows. And so this is a case where someone is loaning their money out. So who does this? Banks. So banks have a big cash outflow. They give us money to buy a car, to buy a house, and then they have future cash inflows. It's just the total reverse of the first, but the math does not change at all between present value and future value. Only the sign will be different. So the present value will always have a negative, future value and payments will have the opposite sign. So you can again view this as a company or an individual borrowing money, or as a company or individual loaning money, but it doesn't change the fact. Now, there are 4 factors in the time value of money, and it's all about this timeline here. So day 1, that's the present value of the money, and at the end point, that would be the future value. And this would be a simple situation where we just have one payment out and then one payment back in. And that would be a simple thing, but we could also have payments along the way. And what determines how large the future value will be? Well, first of all, what is the interest rate? I would think you would agree it's pretty common sense. The higher the interest rate, the higher the future value will be. Conversely, if you know the future value and you're trying to determine what the present value, the higher interest rate, the lower this present value is going to be. Because the difference between the present value and the future value is the actual interest dollars. So a higher interest rate is going to result in a higher future value. And the other thing that's going to matter is N. Number, and I'm going to say this to do it right, number of compounding periods. Now, the higher the N, the longer the money is outstanding, being used by someone else. Again, the higher the future value will be. And if you were able to watch the first lecture on time value money, you know, the more compounding periods, the higher the interest cost will be, the higher the future value will be. Now, if we look at this, we've got PV equals present value, future value, and I will use, you know, the FB and the PV, you know, and abbreviations from here. PMT equals payments or annuities, you know, a series of equal payments along the way, like a mortgage or a car loan. And I is going to equal the interest rate. Now, we're always going to see the interest rate expressed as a 12-month period. And if we have more than one compounding period during the year, during the 12 months, we're going to have to take and calculate the interest rate for that compounding period. For example, if it's compounded quarterly, that means there's going to be 4 compounding periods during the year. I got to take my 12-month rate, and divide it by 4 to get my rate for each compounding period. And then N, that's a really bad N, is number of compounding periods. And so again, N is equal to the number of years times the compounding periods inside of each year. So if it was a 5-year loan, compounded quarterly 4 times a year, N would equal to 20. Now, here's what's great about this. Once you know there's 5 variables here, once you know 4 of those, you know the other one. I want to make sure. One thing I got to check here on my, just got to check something really quick. Yes, I just want to make sure this is recording, because if it wasn't, I'd have to start all over again, and I did not want to do that. So sorry for that interruption. I just had this thought of paranoia that this was not recording. I didn't see anything that showed that this was recording. So, you know, again, my lecture is not always going to be the most polished, you know, in the world, but I hope to, my goal, having a lot of business experience and everything else, trying to make this simple for you, as simple as possible. So it's not just, you know, textbook oriented. So again, there's 5 variables here. If you know 4, you can calculate the 5th one. How will we do it? Either through the tables that help us, or even better, my financial calculator. I use a HP 12C. I think a lot of people like the TI, the Texas Instruments version, which I should use that since I am in Texas, but I am really love my 12C. There's fewer, 12C is cool because there's fewer key punch requirements there. Now, the only other thing about this payment we got to know is it PVA due, AD, a present value of annuity due. That's a annuity due payment at the beginning, or is it a present value of an ordinary annuity? Payment at the end. Usually, we're going to see ordinary annuities for most loans, mortgages, installment loans, car payments. That's usually an ordinary annuity. Annuity due, payment at the beginning think rent. I'm sure many of you are renting. You got to pay your landlord at the beginning of the month. And so from the landlord perspective, we're going to, companies that are doing leasing as their primary business, a lot of their loans that they're loaning to others is going to be in the form of leases. And so they'll get payments back at the beginning of each compounding period. And so we'll have to know this, either to use the right table, because there'll be a different table, different factors, different interest rates if it was paid at the beginning of the month or the end of the month, and really use your calculator. Calculator gets really dangerous because once you set it to begin mode and you forget about it, you go to the next problem that's an end mode, you forget to change it back. And that can just, I see a lot of students who do that. And the, when you're doing an exam, it's pretty intimidating. And so that's, certainly easy to do. So you got to try to remember to change that off. So I've got, for today, I've got 5 problems going to work, just hopefully more realistic problems, kind of, bring this home to you a little bit and make it, and I can work these with you and we can figure this out. I think this is, I like working problems on the lecture, and I think it's really good for you to work problems because then you internalize it and you really get a better understanding of how these time value money problems are used in real examples. So here's polling question number 1. I usually do these as polling questions in class, but this is going to be on YouTube, so you will not be able to answer the polling question through the iClicker software that we use at UNT. So what I would suggest is that you stop the video and go work this, and then restart the video and watch me work it. But before you do that, I'll pause here in a minute. The first thing you want to do with these problems is figure out, hey, what kind of problem is this? And so I look at this situation here. The company sold equipment to a customer and they received a $1,000 2-year note receivable. That means someone's going to have to pay them this $1,000 back at the end of 2 years. And there's 8% interest. That's an annual rate, compounded quarterly. Now, here's what's interesting. The interest and principal will be paid at the end of 2 years. So there's no payments along the way. So I already know PMT, payment, equals 0. On one of our variables equals 0. Future value, that's also equal to 0 because they won't pay anything at the end. They're done. They're just paying, the future value, that's what we're looking for. We don't know that. I misspoke there. The future value, we don't know what that is. They do owe something at the end. They owe the whole amount at the end, and there's no payments along the way. And we know the present value is $1,000. So this is a simple problem. So with that, I'm going to pause and let you guys work this and then come on back. Okay, let's get started here. So this is question number 1. So I know what the present value is. The present value, that's what we're trying to figure out. No, we know the present value. I'm sorry. Oh my gosh. The present value is a $1,000 note. And we know the interest is equal to 8% for 12 months, but this is compounded quarterly. So I got to divide that 8%, I got to divide it by 4. Each compounding period, which is 3 months, is going to have a 2% rate because interest rates are always expressed as annual rates, but that's not how this works. This is a compounded quarterly, meaning there's going to be, we're looking for the interest rate for each N. How many N's are there? N is going to equal to 2 years times 4 compounding period per year, so N equals 8. So it's 2 years, but each one of these 8 periods is going to get a 2% interest rate. So think about it, divide by 4 to get to that rate, multiply times 4 to get to your N. Kind of makes it easy. Payments along the way equals 0. We're looking for the future value equals to X. That's how much they will have to pay at the end. So, so I know the PV, the interest rate, the N, and the payment. I just got to go figure out the future value. This is a simple kind of problem here. And so what table am I using? I'm looking for the future value, so I will use the future value table. Now this table is for $1. So whatever factor I figure out, I got to multiply it times 1,000. And so my interest rate equals 2%. There's 2%. Going to come down here to 8%. And I come right to this factor. $1 would be equal to, under these situation would be equal to $1.17 and 1.66. So the future value is going to equal 1,000 times 1.17166. I don't know if you guys could see that table. That's probably pretty hard to see there. See where the column, 2%, and the number of periods. And so the future value is going to be equal to 1,000 times 1.1766. There you go. That's using the tables. And the tables are okay. Maybe on an exam, it would be good to use to check it. Make sure I'm in the in mode here. So let's go look at how it works in a calculator. So I've got, just see how easy this is. I got $1,000 in the present value, 2% interest rate in periods, payment equals 0. And how much is my future value? 1171.66. 659. It does that even a little better there. All right, let's go to number 2. Again, I'm going to pause here for a second and let you go out and maybe you pause your video, try to work this one, and then come back and you can listen to me work it, watch me work it, and hopefully we get the same answer and you can grow in confidence. If you don't get the same answer, you've got some work to do. All right, so what we have going on here, we have a second piece of equipment listed at a selling price to a customer. In lieu of paying cash, the customer is going to pay $1,000 at the end of each quarter. So we know it's looks like an ordinary annuity. It's paid at the end for 5 years. So how many payments will there be? It's going to be in is going to equal 5 times 4 payments per year, 20. So how much is it going to be? 20,000 in total payments. Think about that for a minute. And we're going to be looking for the present value, so you know it's going to be less than 20,000. So if you're doing this right here, it's not equal to 20,000. If it was equal to 20,000, would be the interest rate would be 0, but there is an interest, and so I could almost, without even thinking about this, I think the answer is going to be A, because there's going to be a lot more than $480 of interest, along the way. Again, the difference between the present value and the future value, or the difference between the present value and all the total payments, that's interest. And so the present value is always going to be lower. And that's what we're looking for. What was the selling price of this equipment? And that would be good to know. It's like if you're in business and you want to make sure, hey, they're not scamming you, you can go calculate this present value and see what it is and see, how is that a good price for that equipment or not? They may hide a higher price in the fact that you're just paying. Don't worry about it. I hear this all the time on the TV advertisements, or when you walk in the store, furniture store. Hey, it's only $500 a month for 30 years. You don't calculate it. You just think, oh, $500 a month, I can handle that. Wrong way to think about it. Got to go calculate what is the true price of that. And that's what we're doing here. And so this is a good thing to do personally, or in business as well. So do we know the present value? No, that's what we're looking for. Future value, it's going to be 0, because once we have paid all of those $1,000 payments, we don't owe them anymore. No in payment, right? Just $1,000 a month. And so we know that payment equals $1,000 a month. How many periods are we going to be paying that for? 5 years times 4 per year. So in equals 20. Then let's go calculate my interest rate. Now we're calculating the interest rate for each of those 20 periods. And so the interest rate is 12%, and that's an annual rate. So I could divide that by 4, because these periods, they're 23-month periods. So that equals 3%. Is this an ordinary annuity or an annuity due? We got to know that. And so it's paid at the end of the quarter. So when I go to my tables, I'm going to be looking for the present value table, because that's what we're looking for. And the payment is at the end of the period. That's an ordinary annuity. So here's the future value of $1, wrong table. Future value of an ordinary annuity. No, I'm looking for the present value. Here we go. Present value of an ordinary annuity. And so the present value is going to be equal to this payment times the factor that we're going to use. And so we're looking for 3% over 20 periods. So here's the column for 3%. I've already circled it to help myself out. N equals 20, come across 3%, where these cross 14.877 87747. That's the factor. And so the answer is 14,877.47 cents. So, you know, let's think about this as business people here for a second. The customer is buying, if we were buying this equipment, we're buying it for 14,877. Is that a good price or not? That would be an operational decision. I can't answer from the day of the year, but I'm able to calculate what the price is versus just, hey, don't worry about the price. It's $1,000 a month for 20 quarters. You know, don't think about it. They don't want you to think about it. They want you to say, oh yeah, I can afford that. I'll take it. No, you want to go calculate based on whatever interest rate would be appropriate to you. For this company, it would, it's 12%, and they calculate 14,877. Could they go borrow money from a bank cheaper and then offer a cash price of 12,000? So I mean, I'm trying to give you a feel for how this might be used. All right, let's go to question number 3. And I'll pause here for a second and let you guys work this. All right, let's get started here. So Bob leased a brand new Camaro for 40 months. The value of the Camaro was $25,000. Residual value at the end of the lease is 0, so future value is going to be 0. And the imputed interest rate on the lease is 12%, compounded monthly this time, not quarterly. So there's going to be 12 payments per year. How much is the lease payment? So this will be a good thing to know when you're going in to buy a car. You know, I used to take my financial calculator with me when I was looking at houses with real estate guys and say, okay, can I afford this house? How much is the monthly payment? And I knew about what mortgage rates would be. And so there's a lot of times when I was younger, I carried my financial calculator with me to look at cars, to look at houses, because I know I was going to be a borrower. You know, I didn't have that kind of money laying around. So let's go look at this. So we know the present value equals 25,000. That's how much the car is worth, how much they're selling it for. And the future value is going to be 0 because after we make all these monthly payments in this installment loan, we owe nothing at the end. That's how installment loans work. So the future value is going to be 0. Payment, well, we don't know that. But we do know the interest rate, and we do know N equals 40, 40, and those are months. So this is 40 months. And the payments are monthly payments. So this is compounded monthly. And so 12%, a 12-month rate divided by 12. So the rate for 1 month would be 1%. Okay, so now this one gets a little hairy because I know that the present value equals the payment times the factor, and this is they're paid at the end of the month factor for the present value of an ordinary annuity. So now I got to take divide both sides by this, so present value divided by the factor equals the payment. So I had to do a little algebra there because I know this and I know this, but I don't know that. The present value is 25,000. Let's go see what the factor is. And again, we're looking at the present value of an ordinary annuity, and it's 1% times 40. So I go to my 1% column all the way down to 40, and that factor is 32.83469. I'll get that right, 83469. So I just do my calculator magic on that. 25,000 divided by 32.83469 equals 761.39. Okay, that makes my hair hurt. I would not be able to carry all these tables into a car dealer shop and do this work. So let me show you how much easier it would be here. So I want to make sure first I'm in the in mode. You see that for my calculator, I don't know if you can see it. There's an in mode there. Make sure it's in the in mode. Clear everything out, so I don't have anything there. And so I go present value, future value equals 0, 1% interest rate, 40 in, and how much is my payment? Oh my God, so so much faster, so much easier than using these tables. Again, never use these tables except when I was taking this class many years ago. So I will allow my students to use a calculator, and hopefully they learn how to use that calculator. All right, now the next two problems are really interesting because I put these problems in for a purpose, because the next two problems are how we would use the time value of money in chapter 15, leases, in chapter 14, bonds payable. So I kind of did these backwards, I guess, because this first one is going to be a lease problem. So again, I'll pause the video here, you pause the video, try to go work this on your own, and then come back, watch me work it. Okay, so this is a lease. As I said, most leases are, this is probably, I just know right up front, it's going to be the present value of an annuity due, meaning payment at the beginning of the period, because most landlords, they want their money in the first day of the month. I remember those days when I was renting. So here, and companies lease also. So this Mean Green company leased a building in Denton to use as their headquarters. The annual lease cost was $100,000. There's one payment per year due at the beginning of the year, $100,000. Lease term is 20 years, and incremental borrowing rate was 6%. What is the net present value of the lease payments? Why do we care? Well, as accountants, we're going to care because we're going to debit right of use asset for that present value, and we're going to credit a lease obligation. And that's chapter 15 right there. And so you're already way ahead of the game if you can figure out how to do this, because you will be doing it in chapter 15. All right, so let's see what we've got here. Present value, we don't know that. Future value is 0, because once all these lease payments are made, the lease is over, we're done, we don't owe any more money. And then payment equals 100,000 per year. My in equals, it's not compounded, it's just once a year, right? Payment. So N equal 20. You can do 20 times one compound 20 if you want to. That makes sense to you. Interest rate is 6%. And that's a 12-month rate. We're doing a 12-month compounding period. Each of these 20 periods are 12 months. So I'm done. I don't have to divide by anything or anything else. And I know this is going to be a present value of an annuity due payment. These payments are at beginning of period. All right. So last table we looked at was the present value in ordinary due, future value of annuity due. We're looking for annuity due, but we're not looking for the future value. We're looking for the present value of an annuity due. All right. So we're looking for the present value of annuity due, N equal 20, I equal 6. Okay, here's 6% right here. And I already have that circled at N equals 20, 12.15812. So the present value is going to equal 12 point, let me write that down, 15812 times the payment amount, $100,000, equals to $1,215,812. Or, and our problem would have been B, 1.216 million. Now, what's a total? I just want you to think through this for a minute. What's a total amount of payments that we made? We made 20 $100,000 payments. So total payments equal $2 million. Present value equals 1,215,812. That's a pretty big difference. I think it's like a 700, about $784,000 difference. That is interest. So each of these payments included, an interest component. And so over 20 years, that's a lot of interest. So that's how you would think about it. Longer period, higher amounts of interest. And so $784,000 of interest, if you will. And so in accounting, we've got to account for that as an interest expense if we're the ones leasing the building, or interest income for the mean green company who's leasing it to someone else. So we'll look at, kind of both sides of that as the lessor or the lessee. And so that's kind of a quick introduction to chapter 15. All right, here's a lot harder one. This is from chapter 14. Hopefully, I am sure it's really hard now, but after we get through chapter 14, you'll have this down. And you better, because you will actually have to calculate the price of a bond. And in principles of accounting at UNT, we look at bonds payable, we do the accounting, but the price is already always given to you. But it's a mathematical price determined through the time value of money. So here we are, we're going to go calculate the price of this $1 million bond. And before you pause and work it, I'll let you know, think about this as two different cash flow streams. One with $1 million payment at the end, and another one with annuity, $50,000 payments along the way. Think about it that way. And not to totally give you the answer, but we're going to discount this. We're going to use the market rate of interest as our interest rate. The stated rate is only done for the payment. With that, I will pause just for a second so that you can pause, and then you can go work this problem. All right, welcome back. If you left, with any time value of money problem, you kind of want to think about what are the cash flow streams here. And so The present value, that's what we're trying to determine. That's the price of the bond. And that price of the bond is going to be equal to the present value, of all those future cash, from the company standpoint, cash outflows. They're going to receive the price up front, cash inflow for the company, and they're going to have cash outflows. Now, guess what? We know what the cash outflows are. How do we know that? This is what we call the stated rate or the coupon rate on the bond. That's a 10% rate. And so what are the payments they're going to make? It's that coupon rate times what we call the principal or the par value. So it's $1 million bond. It's going to pay 10% of $1 million every year, $100,000 a year, but it's compounded semi-annually. So they're going to do 2 payments a year. So 2 payments of 50,000 equals that 100,000, 10% interest. So all along the way, I won't do this, there's going to be $50,000 payments all along the way here. At the end, the company's got to pay back the principal amount of the $1 million. So what we're trying to do is look at the present value of all of these future cash outflows. And that is the price of the bond. For the investor, he's going to give the company, cash. The investor will have a cash outflow to the company, and then all these things will be cash inflows for the investor. But the price, the math isn't going to change at all. And so now we're going to go do a finance problem, if you will. We're going to calculate the price of a bond. And so that's, I think that's pretty cool. And I love bonds, especially as an investor. So let's do 2 problems. Let's just look at this one by itself. We're going to look at the present value of this $1 million, and then we're going to look at the present value of these 50,000, and then we're going to add them together. That's the only way you could do this problem if you're going to use the tables. So let's look at the present value of $1 million in how many years is this? 10 years. So present value, we don't know. Future value, we do know. Future value is going to be $1 million. Interest equals, and we're going to discount it at the market rate. The company's paying less than the market rate. And just let you know, you don't really, I wouldn't assume you would know this now, but the company is paying less than the market rate, then this bond is going to be discounted. It's going to be priced at something lower. So we're going to discount this out back at 12%. How many compounding periods? There are 2. It's semi-annual. So I'm going to divide that by 2. So each period is going to be discounted or have a 6% interest rate. N equals 10 years times 2. 2 payments per year equals 20. So now I've got a pretty simple problem. The present value is going to be equal to $1 million times my factor. And this is a simple one. Here's my future value table. That's wrong. I'm looking for my present value table of $1. And let's see, I've got 6% interest, N equals 20 times 0.31180. So that's equal to 311,800. Okay, let's now, but we're not done yet because that's only one of the income streams. We got to take care, we got to understand the present value of these payments also. And so, in the payments, payment equals 50,000. N doesn't change, still equals 20. And I doesn't change, still equals 6%. And so what's the present value of this? It's going to be 50,000 times the factor. And this is now going to be an ordinary annuity. These are paid at the end of each period. I don't know if they tell us that, but that's just the way it works with bonds. They're paid at the end of the period. The present value of 50,000. So I got N equal 20. So ordinary annuity, present value of an ordinary annuity. I'm in the right table. That's good. And I've got 6%, N equal 20, 11.46992. So just half the challenge in this whole chapter is making sure you understand what kind of time value money problem is. Is it a simple one like we had here, or is it a more complex one with payments? And then is payment at the end or the beginning? That gets you to the right table and to the right math on your calculator too, by the way. So I take 50,000 times 11.46992, and I get 573,496. So what's the present value of the bond? Equals 311,800 plus 573,496. $885,296, and the answer would have been B in this iClipper polling. But again, why is the 885 less than the $1 million bond? This has a little bit of nuance to it, if you will. The reason it's less is because when we use the word, I'm discounting it back. That means another way of saying I'm calculating the present value. I'm calculating the 12% present value back at 12%. So I'm reducing those future cash payments down by 12%, but a company is only paying 10%. By the way, if the company had paid 12% and we're discounting back at 12%, that answer would have resulted in $1 million, no discount. But the fact that we're discounting it back means it's less than $1 million. And I hope it makes sense to you, because why would you pay, so investors are going to give the company $885,000 to get those future cash streams from a bond. And as an investor, you would never want to pay $1 million for $1 million bond if they're only paying 10%, when you can go get 12% somewhere else in the market. So hopefully that makes sense, that investors are going to pay less because they're going to get less interest than they could have got in the market. Again, don't worry if you're confused. We'll get to that in chapter 14, and we'll go through it, step by step. You might still be confused. Bond payable is not an easy subject for anybody, but at least for today, for this lecture, we are done. And I thank you for spending time with me, and hopefully you get a better feel for time value money. Certainly, this is something you can use in your personal life. Really, really good to know. So thank you guys, and we'll talk to you later.